Welcome back to our series on index funds versus ETFs. In part 1, we covered the basics like expense ratios and tax efficiency. If you missed it, be sure to check that video out. Today, we're diving deeper into accessibility, dividends, and which one might be better for your long-term goals. Let's start with how you actually buy them. When it comes to accessibility, ETFs generally have the upper hand. You can buy and sell them on pretty much any stock trading app you can think of, just like you would with an individual stock. This makes them incredibly easy to get into, especially for beginners. Plus, with ETFs, you can start small. Many brokers let you buy as little as one share, and some even offer fractional shares, so you can get started with just a few dollars. Index funds, on the other hand, are a bit more traditional. You usually need to go through a brokerage firm or directly to the fund provider, like Vanguard or Fidelity. Sometimes, they have minimum investment requirements, which could be a few $1,000s, although this is becoming less common. So, if ease of access and a low starting cost are your priorities, ETFs definitely pull ahead. Now, let's talk about something we all love, dividends. The good news is, both index funds and ETFs can pay them out. When the companies within the index you're tracking pay dividends, that money gets passed on to you as an investor. With ETFs, this process is pretty straightforward. They typically pay out dividends in cash to your brokerage account on a quarterly basis. From there, you can choose to take the cash or reinvest it back into more shares. Index funds handle dividends a little differently, depending on the fund structure. Most mutual funds will give you the option to automatically reinvest your dividends. This is a fantastic feature for long-term investors because it puts your money to work immediately, compounding your growth without you having to lift a finger. So, while both offer dividends, index funds often make the reinvestment process more seamless and automated. So, which one is better for long-term investing? It really boils down to your personal style. If you're a set-it-and-forget-it type of investor, index funds are a brilliant choice. The ability to set up automatic investments, say, a certain amount from every paycheck, and automatically reinvest your dividends makes them a powerhouse for consistent, hands-off wealth building. It takes the emotion out of investing and keeps you on track toward your goals. ETFs, however, are perfect for investors who want more control and flexibility. Because they trade like stocks, you can buy and sell them throughout the day. This gives you precise control over the price you pay. If you enjoy being more hands-on, analyzing the market, and making strategic moves, ETFs offer the flexibility you're looking for. You have the freedom to react to market changes instantly, which can be an advantage for active traders. What about risk and returns? This is a question I get all the time. Here's the simple truth. If an index fund and an ETF are both tracking the exact same index, like the S&P 500, their risk and returns will be almost identical. The performance isn't really determined by whether it's an ETF or an index fund. It's all about the performance of the underlying index they're designed to mirror. Any small differences in returns will likely come down to the expense ratio and tracking error, which we talked about in the last video. So, don't get too caught up thinking one is inherently riskier or more profitable than the other. Focus on the index they track. So, after all that, which one should you choose? Let's wrap it up with a final verdict. There's no single right answer, but here's a simple guideline. Choose index funds if you value simplicity and are focused on a disciplined, long-term strategy. They are perfect for automatic investing and make it incredibly easy to stay consistent without having to think about it. If you want a hassle-free way to build wealth over decades, an index fund is your best friend. On the other hand, choose ETFs if you want maximum flexibility, potentially lower costs, and complete control over your trades. They're great for investors who want to be more hands-on, take advantage of intraday price movements, or build a highly customized portfolio across different brokerage platforms. Ultimately, both are fantastic tools for building a diversified portfolio. Many successful investors actually use a combination of both. You might use index funds for your core, long-term holdings and ETFs for more tactical, specific investments. The most important thing is to understand your own investing style, your goals, and your tolerance for being hands-on. I hope this two-part series has cleared up the confusion between index funds and ETFs. The key is to just get started. Don't let the decision paralyze you. Pick the one that feels right for you and begin your investing journey today. Thanks so much for watching. If you found this helpful, please hit that like button and subscribe for more content to help you master your money. Let me know in the comments which one you're leaning towards. index funds or ETFs. See you in the next video.